Good morning, everyone. Welcome to another special edition of our podcast where we addressed important topics regarding employee benefits. Today, we're going to talk a little bit about benefits in mergers and acquisitions, in particular, executive compensation matters. My name is Jeff Banish. I'm joined today by my colleague and partner, Josh Gelfand. We're both partners in Troutman's employee benefits and executive comp practice, as well as in the private equity subgroup.
Yeah, thanks so much for the introduction, Jeff. This is Josh Gelfand. Executive compensation is a complex and often contentious issue in M&A transactions. It's not just about the numbers, it's about fairness, transparency, and aligning interests of executives with those of the company and its shareholders.
Yeah, and also there's plenty of legal implications from tax to regulatory that need to be navigated as we go through this process. There's a lot of different stakeholders here, whether you're an executive impacted by the transaction, a board member, an investor, a shareholder, all get impacted by benefit issues. And it's really important that everybody understands and makes informed decisions about what's happening to avoid costly litigation or missed, sort of hidden contingent liabilities out there so that everybody knows going in, they get the benefit of their bargain.
Yeah, absolutely. And today we'll be discussing key considerations, common pitfalls, and best practices when it comes to executive compensation and M&A, and in particular, employee benefits in the context of merger and acquisition transactions. And I think it's important to level set and kind of set the table at what are some of the key concerns and things that we focus on, and what are the material items around this area. So I think first off, it's determining if there are any hidden or contingent liabilities that aren't reflected in the financial statements or other immediately obvious diligence. Then it's, once you understand what liabilities are out there, ensuring that they're properly allocated in terms of risk and in terms of who's covering the costs of those in a transaction, negotiating the terms of the acquisition, both the risk allocation as well as purchase price adjustments, employment contracts, arrangements like that, ensuring an orderly transition of acquired employees and benefit plans. Oftentimes, that's informed by the type of a purchase transaction that's being done, whether it's an asset sale or a stock sale, and we can get into that. And then information necessary to coordinate and integrate the target's benefits with the acquirer's benefits. If you're in what we'll call a strategic acquisition, which is where you have an operating company acquiring another operating company, and so they both may have benefit plans from the get-go, and figuring out how those play together and how you can kind of consolidate those. And I think that's kind of the 30,000 foot view. Jeff, let me know if you think we left anything out there. And otherwise, I'll throw it over to you about initial steps and due diligence.
Yeah, no, thanks, Josh. Yeah, let's start sort of at ground level zero. And I'm going to mention a few things that really seem like common sense, but you'd be surprised how many sort of benefit lawyers sort of jump into the benefits and don't really do some of this preliminary analysis that really level sets where everybody is, which is, when you get into a transaction, the first thing the benefits lawyer needs to do is, you should read the letter of intent. If they have it there, the parties have, set forth what the initial agreements are. You should understand what those are, read the letter of intent, understand, more importantly, the form of the transaction. Is the stock deal? Is the buyer buying assets? It is a merger. The form of the transaction really is going to, sort of set the stage of what we need to be looking at, because different benefit plans are impacted differently by just with the structure of the transaction. Josh, if you got an asset sale, the acquirer is only going to acquire assets, and for the most part, is only going to assume the liabilities it intends to assume. Now, there are differences there because there are liabilities that may be imposed by law, and those are things we'll talk about later. Whereas if you have a stock sale merger, generally the acquirer is going to succeed to all the assets and liabilities that the target, no matter what they do. If they buy the company, they buy all the stock of the company, they're buying the company, lock, stock, and barrel. And that comes with all the liabilities that the corporation or other entity may have. So it's important that we look at the structure of the transaction, and also sort of, look at where the benefit plans are. If you're buying a subsidiary and the benefit plans are housed at the parent level, well, then the buyer's not taking those benefit plans with them unless the buyer does something to actively assume them. Whereas if I'm buying a subsidiary or an entity that has plans, then those plans are going to naturally come with the entity when I buy it. unless I do something, otherwise. So you've got to understand the transaction and where the benefit plans are, where the employees are, so that you can understand basically what's going to be impacted, what the buyer may be assuming or not assuming, and then what other reps and warranties need to be sort of in place to address, what Josh mentioned earlier, to understand liabilities and then allocate it among the respective parties, because that's ultimately what the transaction document's going to do, as well as discuss, what's happening to the employees. So keep that in mind. I think that's step one. Don't jump right into the analyzing benefit issues. I think first understand the transaction and the basics so that you understand where the plans are, what employees are impacted, and sort of, it helps you put the whole thing in perspective.
I totally agree. One thing I would add on to that, because I think that you're completely right, and you have to get a good understanding of what the structure is first, is another type of transaction that could be in play is what I would call like a carve out transaction, right? Where you're acquiring a segment of a business, and it might be that you're buying the segment in the form of a stock deal, but because it's only a division or a subsidiary of another entity, it's quite possible that you have benefit plans or employees that are not located at the entity that you're acquiring. And so it's important in those situations to have a good understanding of where they sit. And then also, if there are any shared service employees, employees that are employed and maybe not coming with the business, but who render services and are necessary for the business. And then you have to figure out as part of that, how you're going to address those people. Do you need them day one? Do you need to bring them over? Do you need to have a transition services agreement or some other arrangement that will allow you to run the business and give you some runway until you can either get your own people on board or transition people over? So, items like that are also important in carve out transactions where even though it might say stock deal, you might have some of the aspects that you would normally look at with an asset deal where you're not automatically bringing benefit plans or employees across.
Yeah. And Josh, another good point I think to emphasize here is, all that is to understand where the plans are, what's happening. But, at this stage of the game, nothing is locked in. I mean, we, as lawyers, as we analyze the transaction and where benefit plans are, liabilities, now's the time to understand that so that if you don't want to take a plan or, depending on what's happening, you're at a stage of the game where you can plan accordingly and potentially take actions to move plans or move employees around. So now's the time to understand it because once you, sign off on the deal, sort of, the ship sailed, there's no way to really do a lot of structuring without getting the other party's consent.
Yeah, and I think another piece of that too, in terms of kind of trying to understand and plan ahead as quickly as early on as you can, is whether or not the deal is going to be a simultaneous sign and close, or whether there's going to be an interim operating period between signing and closing. Because some of the items that if you have a period of a month or longer between signing and closing, you have additional leeway to get administrative matters done that if you have just a simultaneous sign and close, you don't, right? Because oftentimes, if you have a simultaneous sign and close, but you've got benefit integrations issues, it can get kind of tricky to figure out how that's going to do when not everyone at maybe the buyer and the seller are under the tent and aware of the deal. So you've got to figure out ways of squaring that circle to make sure that you get everything done that needs to get done without opening up confidentiality issues and leaking a deal too soon because it's there's HR people brought in or something to that effect. So that all that kind of inform how the structure is going to work and how it's important to raise to the clients and have them start thinking about those issues early on.
Yeah, and you bring up a good point. You talked about the difference between just a sign and close or having a period between signing and closing. Because once you understand that, you realize that, well, you need to take care of that interim period. What is the buyer going to allow the seller to do during that period? I would think buyer would want to, for example, have some control over what employees would be hired or fired or what plans could be changed. So that's one of those steps where when you understand the transaction, okay, now you understand you also have to take care of this interim period where the buyer may want to have some control or a lot of control over what happens in the interim period because they don't want to be locked into buying something that changes considerably between signing and closing.
Yeah, I think that makes a lot of sense. And I think that that's a good place to kind of tie in I think that there's diligence, there's the purchase agreement, there's post closing, and there's kind of all the interplays between. But at least in my perspective, oftentimes it's done simultaneously, right? Oftentimes they say, you get a call, we're doing a deal, we want the diligence done, and we're also negotiating a purchase agreement at the same time. And so sometimes you may not have the full picture at the time that the purchase agreement is going forward. And so the way that I often think about it, and I'd love to hear your thoughts as well, is that you kind of use those two things together where, you know, if you have the diligence, you can tailor the purchase agreement to cover whatever it is you need to cover or not cover. But if you've got less visibility on the diligence side, then you can use the purchase agreement as a lever to kind of uncover or force the target to disclose and uncover issues that you haven't yet seen. So if you require them to make representations that are what I'll call flat representations without any caveats or qualifiers, you can pressure them to say, okay, make this rep. And if they say, no, we can't make this rep, you can then have the conversation and, well, why? What do you have out there? And get a better understanding of what might not have been disclosed yet in the diligence side.
Yeah, no, you bring up a real good point, which is it's a fluid process. And we don't come in and look at the agreement and mark up the reps and then we go away. The benefit lawyer stays involved in the entire process. And as they do diligence and they discover more issues and more problems, that tells you that maybe you need to supplement your representations. You may be asking the seller to correct certain things in advance and add covenants to the agreement. So it's a very fluid process and you've got to stay on top of it and make sure that, as things come up for the deal, you have to be there to respond to it, appropriately and not just think that, okay, I looked at it up front, I'm done.
Yeah, agreed.
That probably puts us into the next topic would be diligence.
I think that's right. And I think that when people talk about benefits lawyers or benefits in M&A, oftentimes I think it kind of conjures up the image of like a health and welfare plan or a 401k or a pension. And those are certainly important. But I think that in the context of what we typically cover, that's not the full universe and everything that there is. So the way I often think about it in terms of the areas of diligence that we focus on, there's several buckets, right? There is health and welfare plans. There's qualified retirement plans, which are defined contribution plans like 401ks, where the amount going in is set, but the amount going out is borne, the risk of loss or the risk of fluctuation is borne by the employee. Then there's defined benefit plans, which is the inverse, right? Where you've got a fixed amount that the person is entitled to at the time of distribution. And therefore, the risk of loss on fluctuations is borne by the employer. So defined benefits, so pension plans. So there's the retirement plans. Then you've got compensation arrangements, employment contracts, severance, transaction bonuses, things of that nature. And then you have equity, right? So incentive equity can take the form, I mean, there's multiple forms, but stock options, restricted stock, restricted stock units, which are really just contractual promises to make payments settlable in they're based off of the value of equity. So it's not a real property instrument or equity instrument. And then oftentimes you'll see now profits interests. Profits interests can have their own whole topic, but essentially when you have partnerships or LLCs taxed as partnerships, you can issue a profits interest in that partnership, which when structured properly will allow the person who receives the award the benefit of the preservation of the character of the distribution from the underlying that the partnership gets, which is a long way of saying that if they sell in a transaction and there's capital gains treatment on the sale, then the holder of the profits interest could also get capital gains treatment on the sale. That's a high level point. So I think those are kind of the buckets around the types of things we would look at in the transaction.
Yeah, and Josh, I would say, and those buckets are not always, it isn't always self-evident what liabilities and obligations are in play because, someone says, okay, 401k plan, what's the big deal? The money's set aside in a trust. Benefits are basically whatever's in the trust for the individual. But, many plans, it's the so-called, hidden or contingent obligations that are the gotchas. For example, where you mentioned non-qualified deferred comp plans. Well, there may be a huge liability for that that is fundamentally unfunded. So that's something that the buyer would have to assume and would want to understand the scope of that. There's other interesting issues like under COBRA for a welfare plan, people says, well, it's a medical plan. What's the big deal? Well, the question is it insured? Is it self-funded? If it's self-insured, is there adequate funds there? What's the, claims incurred but not reported yet liability that could be, quite large. You also have the issue of, with Cobra, I always get clients are surprised when they find out they buy a company and they find out they have to offer Cobra to an employee that never worked a day for them. Well, that's, the law may impose that obligation in different circumstances where you have to provide Cobra to a group of folks that never worked a day for you. And you may say, well, yeah, but they're paying the premium. That's true. But that also tends to be a lot of folks with a lot of health issues. And therefore, you could be acquiring a subset of folks who never work for you that have claims that are far and above what would be normal. So there are some, interesting aspects of all these different types of plan that you really need to scrutinize and you know, sort of get under the hood and make sure that you're aware of what's there and are prepared to handle it, once the sale is consummated.
Yeah, I agree. And I think that another one of what I'd say, there's a handful of material, potentially deal affecting diligence issues. And I think maybe the header on or the leader on that, although it's rare to see it, is pension plan liability from a defined benefit pension plan or multi-employer plan. Now, you don't see that come up so often in many deals now, because oftentimes those are creatures of unions or collective bargaining agreements. And so only to the extent that there's, a union agreement, or you have more old school style companies like, steel mills and car companies, things like that, where you might see it. But to the extent that there is a real, defined benefit pension plan floating out there, that's where you could potentially see substantial exposure. Because again, as I mentioned before, when you've got a defined benefit plan, it means that the risk of loss or fluctuation is on the employer. And so if there's an obligation to provide some fixed level of benefits in the future, because there's market fluctuations and the funding is dropped, you could have a substantial obligation that the target, and therefore when you acquire it, the buyer could be liable for. And not only that, but depending on, even if you haven't incurred that liability yet, let's say you haven't terminated the plan at a loss, the PBGC, the Pension Benefit Guaranty Corporation, which kind of stands as a guarantor of a portion of benefits, hasn't come in, you could still have additional costs incurred if the value of the assets the plan drops below certain funding limitations. It triggers obligations for funding. And then the liability under ERISA for those types of plan shortfalls is joint and several liability across all members of the ERISA controlled group. And the controlled group is effectively, you can think of it as an 80% ownership test that can run across multiple companies. And under certain cases that have come out, it might even flow potentially up to a private equity sponsor that owns the company. So it could, in theory, become a large liability. And so when you have a pension plan, you've got to understand what that exposure is and how to handle it. Now, in a deal, oftentimes, sometimes it's viewed as just the cost of doing business. If it's there, it's there, and you have to just be aware of it. But I have seen times where they negotiate and try to have the buyer or have the seller bear some cost for the funding shortfall, which is effectively a liability, a contingent liability that the buyer is taking on. Sometimes they say, well, you've got to foot some cash for that amount. Now, there's responses on why that might not be appropriate. There's always a back and forth and a negotiation on those points.
Yeah, and your defined benefit plan is one of the big things gotchas you're looking out for. And I might add that it's particularly acute if you have a union sponsored defined benefit plan, which is called a multi-employer plan, where if you have union employees who've been participating in the union sponsored pension plan via the collective bargaining agreement. And what you may not know is that you may take that company on and say, well, we were eventually going to withdraw from the union and work through that process. Well, you may get a big surprise, because if they've been participating in a union sponsored pension plan, the employer may have what's called withdrawal liability. Then they're obligated to basically fund the retirement benefit for the time the employees participated.
that number can be huge. And now all of a sudden you bought a company, you paid, it's not unusual. You paid $50 million for a company and you motor along, and then you find out either the union plan has problems or you want to withdraw, then the withdrawal liability is $15 million. So it's a significant issue that you need to be on top of. As a lawyer, I certainly don't want to be in a position where a client calls me up and says, I bought, X, Y, and Z company. And I said, yeah, I remember that was a great transaction. They said, oh, guess what? You never told me about the $15 million withdrawal liability. And that's a problem. And so I know I don't ever want to be in that position. So those are the kind of things you really got to look for.
No, I totally agree. I think another one of the big ticket or highly focused on issues to think about in both in diligence and then on structuring is what equity is outstanding and how that's being treated in the deal. Because oftentimes the purchase agreements will contemplate treating the outstanding incentive equity, the options a particular way, or vesting something or paying it out. And you want to make sure that you understand what's outstanding, that there's no potential risks or exposures around that, and then that the way that the deal is contemplated as treating the equity is actually permitted under the documents that exist as of that date. So, I mean, a big one, and I'm sure we'll talk about this more down the line, and everyone hates hearing about Section 409A of the tax code. And some people say, what's that? And then people who know what it is just, groan and say this is painful and horrible. But high level 409A is the section of the tax code that regulates non-qualified deferred compensation, which is compensation that vests in 1 year, meaning it's no longer subject to a risk of forfeiture, but is payable or could be payable in a subsequent tax year. And so it's really just that's deferred comp. And so that could cover a broad range of types of compensation, not just a retirement plan, but also stock options, severance arrangements, transaction bonuses, all that stuff. And so a key focus is understanding and making sure that nothing in the deal is going to cause a problem under 409A, because under 409A, the penalty is rather arcane. And the penalty is, give shorthand, whenever an amount is vested, the full deferred amount that is vested is includable in income in the year in which it vests, which means that if you have $100,000 that's supposed to be paid 5 years from now, but it's vested and non-compliant this year, it's as if you've taken to income $100,000 of cash, even if you haven't received it, plus an additional 20% tax on top of that. So no on the employee, on the individual. So no one really likes to deal or feel the pain of 409A, and everyone wants to make sure that whatever is there is compliant or exempt. And if there's any issues, we want to try and get those handled and addressed pre-closing. And I bring that up now, not just to talk about transaction bonuses, but to say, okay, on equity, you've got stock options, which by their nature are deferred compensation or would be, but there's a special exemption under the rules under 409A that says if you've got stock options that have an exercise price that is no less than the fair market value of the underlying share covered by the option on the date of grant, and it doesn't allow for a subsequent deferral, meaning once you exercise the option, it can't push it out later. There's some other rules, but effectively, then you can be exempt from 409A and not have to worry about it. So most options we deal with on a regular basis are treated and designed to be exempt from 409A. And that's important in the deal context because we want to understand when we're doing diligence to make sure that they actually satisfy the requirements for that exemption, primarily so that the exercise prices on the date of grant was no less than the fair market value of the share on the date of grant. And we want to have support for that. And then also various other diligence around making sure you fit within the exemption. Because if you don't, then suddenly you could have a large tax bill for the employees and potential withholding liability on the company at the time of a deal, which nobody wants to have.
Yeah, and Josh, in the 498 analysis is spot on, but I find that the other party doesn't always understand that. I mean, that's one of the reasons you do the diligence, but oftentimes we find when we're trying to go through diligence for a client, the other side either hasn't been aware of 409A or has applied it in an incorrect way, and that has significant ramifications for everybody. And now, we have to go in and either try to clean it up or correct it. but you can't always assume that what you're looking at is compliant. So 498 is a big issue there.
I agree. And many times you'll see representation specifically around 498 compliance to some extent in the purchase agreement. If there's a real problem that people are aware of, you might see an indemnity in the purchase agreement as well for that, to the extent that there's no way to fix it, or to the extent that you're not going to just pay the tax and report it at the time of the closing, which, most people don't want to do. You might see indemnities as well.
Yeah, and these are the kind of things with 498. I have some clients will say, well, why do I care? Doesn't that the executive pays the additional 20%? Well, you should care because, as you mentioned, if 498 applies, you could be subject to taxation when the compensation vests, which is always going to be generally much earlier than when it's paid. Well, as the employer, you have withholding obligations. So now you may have missed withholding obligations 4 years ago that now, have penalties and interest and all the other implications. So the employer does have a dog in this hunt.
Yep. I did a deal a number of years ago for an asset management company. They were being acquired. And so they had the incentive component for most of their senior team was phantom carried interest in their various funds and investments. And phantom carried interest, you could think of it as just the deferred comp arrangement where you get paid cash as if you were getting a carry in each underlying fund. Carry meaning like a piece of the pie on an eventual sale transaction. And the way it was structured was not 498 compliant for this phantom carry. And it ended up, the potential exposure was in the millions of dollars. And we had to figure out a way to clean it up pre-closing and also try to ballpark what the potential exposure was. And a lot of it was on the withholding side, right? Because you say, okay, this all vested over the last 4 years, 3 years, what's the withholding liability that the company should have had? Yes, the company and the employee are both technically responsible for the withholding tax, but the government's going to come after the deeper pockets. And so the company has to be worried about that as well. Not to mention the employee relations issues where, if you've got employees that are getting hit with an additional 20% tax, based on an arrangement that was structured by the company. If you want to keep those people around and they're necessary in the deal, you're going to have uncomfortable conversations, and you might have to make them whole for whatever, costs they incur.
Yeah, that's right. That's right. Well, as we're going through issues, while we talk about the big one, Josh, it's always rearing its ugly head, which is 280G. Obviously what 280G deals with is whenever there is compensation that is, in the language, is contingent on the change of control or an event closely related to the change of control, such as termination of employment, then to the extent the amount of those parachute payments equal or exceed certain thresholds, then what happens is the compensation is subject to an additional 20% excise tax on the executive, and the employer payer loses deduction for that excess parachute payment. And this is oftentimes quite significant in transactions because to the extent executives are, going to be let go as part of the transaction, that's all their severance benefits or parachute payments. In that context, the big issue is if they had outstanding equity that becomes vested as part of the closings, whether it be options, RSUs, restricted stock, whatever, then you calculate the value of that vested also gets thrown into the parachute bucket. And the 280G becomes really a very important issue. In particular, you think about who's affected by it. Well, it's your top level executives, your directors, your major shareholders. And that becomes quite a significant issue where if you've got an executive who's getting a payout, whether it be a change of control bonus or severance and all that, and they're adding additional 20% excise tax, it almost becomes confiscatory because you got an executive in high bracket, you add all the other stuff in there, and all of a sudden now they're at a 70-80% tax rate, which doesn't leave things where they want to, the executive wants it to be.
That is for sure. And on top of that, to your point on 280G, right, there's two penalties because there's two kind of tax provisions that go hand in hand, 280G and 4999. So there's the 20% additional tax on the individual for the excess parachute payments. I mean, we could take a minute to explain how that all works. And then the company also loses the benefit of the deduction for those excess parachute payments. So just to give an example, the way it works is 280G says that if you receive compensation that's contingent on a change of control that's equal or or in excess of 3 times your base amount, which is essentially your average annual comp over the preceding 5 years, well, then anything over 1 times your base amount is an excess parachute payment subject to the 20% tax, and also for which the company can't take a deduction. So, simple example is the person's got a base amount of $100,000. So that means that if they're paid $299,000 in the deal, no problem. But if they're paid $300,000, that extra $1,000 triggers $200,000 qualifying as excess parachute payment because it's their base amount is 100, the safe harbor threshold is 300, and it means that if you're at or above 300, then anything over that first 100 is subject to the additional tax, and the company can't take a deduction for it. So, in other words, just that extra $1,000 of payments would mean $40,000 in additional tax, right? 20% of the 200,000, plus the company could not take a deduction for that $200,000. So it can be pretty painful. Thinking back, kind of tying it back to the beginning of our discussion, I think it's important, especially when 2AG is at play, that it's vital to know and understand the transaction that's occurring and what everything is, because there are only certain types of transactions where 2AG is implicated. And in addition, there might be one where you think it's not, but it could. So 2AG shorthand, very in general, it covers C corporations. So C corporations, when you think of a standard plain vanilla corporation, 280G is not applicable to partnerships, LLCs taxed as partnerships, and S corporations, which are small business companies, which is generally owned by individuals. There's only a maximum number of people who can hold it. There's certain rules around that. So if you've got a transaction where all of the component entities in the transaction that are being acquired or that are selling their interests or their assets are LLCs or partnerships or S corps, but that's going to be unusual, right? 2AG is not going to apply. And the corollary to that is, and I've seen this in I'm actually dealing on a transaction right now, and it happens often where you say, oh, it's all LLCs, we don't have to worry. Well, hold up. There's one C corporation in the structure. Well, now we've got to start thinking about whether we have an issue. And we've got to start thinking about analyzing whether we can get comfortable that that C corp is not going to implicate 280G, or whether or not you have to still be worried about it and think through the structuring of the transaction for that issue.
Yeah, and your point about understanding the transaction is a good one, because this is why early on in the diligence and understanding the transaction, this ought to be an issue you investigate, because there are things you can do to help mitigate it, but you're not going to be able to do it if you wait to the last minute and on the eve of closing, expect to fix things. So, for example, if you got a parachute program, if I'm representing the seller, that's one of the first questions we ask is, have you done a 280G analysis of what might happen? And if they haven't, you tell them we ought to, because we don't want to have any surprises. And now's the time to potentially do mitigation efforts. When I say mitigation efforts, there's different ways we could potentially handle a parachute problem with this. For example, payments for a non-compete are not parachute payments. So to the extent severance or other payments can be considered compensation for a non-compete, then that money comes out of the parachute bucket and could either reduce the excise tax, or potentially, because of how the nuances aren't calculated, eliminated entirely. There's other things to do. If you have a non-public company, you may be able to put the parachute payments to a vote of the shareholders. And if you get a more than 75% vote, that'll cleanse it of the parachute problem. We talked about allocating to the non-compete. If you're going to do that, normally what you have to do is go out and get an independent valuation of the value of the non-compete to justify the allocation, because most buyers are not going to want to just sort of wing it. They're going to want to have an accountant or somebody come up with a number that says, we think the non-compete's worth X, and that X now can come out of the parachute bucket.
Let's go back to your example, Josh, about being $1,000 over the threshold could result in a $40,000 excise tax. There's certainly things that you could consider here. One of those things are where common sense would say, take back the $1,000 and you would save $40,000 in excise taxes.
Wouldn't you do that? And that, that's commonly referred to as cutback. But even if you want to do a cutback, you oftentimes have the executive's got to be on board with it. He or she may need to execute a waiver to allow putting it a cutback or to allow it to put to a shareholder vote. There's even things you can do from the standpoint of, if the closing will occur in the following year, maybe you can sort of juice up the executive's compensation in the year before the closing and increase the base amount, therefore increase the parachute threshold. So there's a lot of things you can do to potentially mitigate the 280G. But again, you're not going to have time to do it unless you're on top of this pretty early.
Agreed. Agreed. And again, this is where it's important to understand whether or not you've got a simultaneous sign and close where it's all got to get done pre-signing, or whether you have an interim operating period between sign and close where you can kind of get this all done or get most of it done between signing and closing. I think the shareholder cleansing vote process that you mentioned, I think I see on private company deals, I think that is at least 99 times out of 100. That's the way that people go, maybe even more, right? So essentially, in almost every deal, if not every deal, in which you've got a private company where 280 is implicated, I think we've almost always gone through this cleansing vote process, which is a three-part process, right? There's the waiver, where the individuals who are disqualified individuals, which are just folks who are covered by this potential risk tax, where they agree to waive their entitlements to payments that would trigger the excise tax, contingent on the shareholder disclosure and the shareholder approval vote. So it's the waiver. Then you would have to disclose those payments, all the material terms of those payments, to each shareholder entitled to vote the payments. And then you have to get the consent of more than 75% of those shareholders. And if you go through that process, then everything is fine. And usually it's non-controversial because typically in private deals, you've got a single private equity sponsor that does this all the time. They're the ones that approve those payments to begin with. So no one is really at issue here. And it's just a matter of kind of explaining and getting the executives comfortable that, that yes, they're actually waiving their right to the payments, but, they have to kind of trust that the private equity sponsor is going to do right by them. And and there's various reasons why the private equity sponsor wants to and get that process done. But that could sometimes be a tricky conversation. I've had situations where I've had to get on the call with the management team and explain this to them and say, no, you're going to have to trust them and you're going to have to actually put your payments at risk, because if you don't, and if there's any protections, well, then that doesn't meet the requirements of the rule, because the rule requires that the vote of the shareholders decides if the payments are made. And so it can't just be, an advisory vote. It has to actually determine the payment. If you go through that process, again, 99 times out of 100, that's what's done. Everyone is fine, and you get the process done, and it's on pre-closing, and then you're cleansed.
Yeah, but Josh, there could be some surprising results where that isn't as easy. For example, I had a transaction where the executive had what they call a gross up, where the company would pay him additional comp to gross him up for the excise tax. And the company didn't want to lose deduction, but they had no mechanism to force the executive to waive it and put it to a vote, because the executive said, hey, I got a gross up I'm taking care of. I don't care about that.
I agree with that. And similarly, you have situations which, if you remember as you know, but as I was saying for the audience, the disclosure of the payments has to be to all shareholders entitled to vote. And oftentimes there's discomfort there. Sometimes people don't want to do that because, yes, you might have equity granted to a broad base of employees who have voting equity. Now, you don't need them to get the approval, but, sometimes the CEO might not want all of those people getting the terms of his or her comp package, which they have to do if they're going to meet the requirements of this process. And sometimes you've got disparate ownership bases where you're not comfortable you're going to get the 75% vote. So you're right. There are certainly circumstances where it becomes more complex.
Yeah, and a benefit lawyer needs to be on top of each stage of that, whether it be drafting the waiver, making sure the disclosure is adequate, and making sure the process is undertaken in a way where it's a meaningful vote and not just a rubber stamp.
Agreed. And I think just as a practice pointer, I would say it's important, as Jeff pointed out before, one of the things that's factored into the calculation is the accelerated vesting of unvested equity or unvested payments. And that's important. And there are times when people will have vested equity, but when you do diligence, when you look at, let's say, the shareholders agreement or some other document, it says, yeah, but if they quit without good reason, if they just walk away, they lose it, right? So it's vested. If you simply looked at the grant agreement, it says time vested over X number of years. Oh, it's fully vested. We don't have to worry. Well, hold on a second. Buried in the shareholders agreement, it says if you leave, you lose it. It's not actually vested. So the full amount will have to be factored in. So there's always nuances and areas that you want to make sure you're looking at to kick the tires to ensure that, for purposes of 280G, this is vested. Similarly, without getting too much in the weeds, you can make an 83B election to take into income and unvested amounts now, so you treat them as if they're vested for tax purposes. Well, 83B is disregarded for purposes of the 280G calculation. So it's very important to have a full understanding of what's out there, what is actually vested, what is not quite vested, and then what might be considered parachute payments in a transaction.
Yeah, very well said, Josh, because it's very nuanced. And you need to be on top of it and don't just sort of breeze through this. This all can be stuff that can come back to bite you.
Yep, agreed. And I think on the 280G point too, from a drafting perspective, I would say, it's very typical to have a representation that nothing in the transaction will trigger 280G. And then also, if you think or you're concerned that as a buyer that, or even as a seller, that 280G might be implicated, you'll want to put in a covenant to explain what the requirements are and how the process is going to go forward for getting that cleansing vote, getting that all done pre-closing.
Yeah, that's right. That's right. Let's talk about too, then maybe Josh, we've spent, I think, a lot on 280G, which is important, but maybe we talk about some of the other issues. I mentioned earlier the COBRA issue that, surprisingly, welfare plans can have a number of issues. I still see deals where the employer hasn't provided, adequate coverage, and therefore the ACA penalties kick in, which can be quite expensive. For a while there, we saw clients getting, penalties from the IRS and to the tunes of hundreds of thousands of dollars for failure to provide sufficient coverage. That's one thing you want to look at. If I'm the buyer, I want to make sure that the seller has been providing coverage and there's not going to be any of these ACA penalties potentially, as well as I talked about earlier with COBRA. If I buy a business and the parties can always choose to allocate the COBRA responsibility for people who are entitled to COBRA, but to the extent, let's say the seller says, "Well, I'll keep that liability," and they don't do it, well, by law, then the buyer who sponsors a plan has to provide COBRA to all of seller's former employees who never worked a day with buyer. So there are things like that you got to be careful about, because on its face, you wouldn't think you owed COBRA for people who never worked for you, but in that circumstance, it could happen.
Now, I think the key, and I think what you're referring to as M&A qualified beneficiaries is the term of art. And I think the key area where that comes up a lot, or you're worried about it, is in an asset deal, right? Because you could have people who are not brought over, but then if the seller liquidates after the transaction, its benefit plans go away, that's when you have an issue, because as the buyer, you're stepping into their shoes for purposes of coverage obligations.
Yeah, exactly. Now, I don't know Josh, what else you want to think we should sort of talk about here? I mean, I think there's a lot of other potential issues, considering historical problems with acquired plans and how employees are going to be treated, after closing, what severance may be owed, what to do with buyers' plans, or how to integrate new employees in a buyer's plans. I misspoke. I should have said seller's plans. I mean, I don't know how much we want to get in at this point, given the time constraint.
Yeah, I agree. I think we could talk about this for days and days, but I think it might be useful to have separate podcasts on some of those points. I think maybe one or two of the things of additional kind of parting thoughts to leave with on the benefits and components is an integration and treatment. So one thing that's often not thought about is when you've got a company, you've got a strategic acquirer. So you've got an operating company that buys another operating company, right? So you've got to figure out benefit integration and also the 401k plan. If you're a buyer with a 401k plan and you buy a company that has its own 401k already, you've got to think through pre-closing how that's going to be treated in the deal. Now, I think most of the time it's advisable to have the target company terminate their existing pension plan because one of their 401k plan, because once you've acquired them and they're in your controlled group, this group of consolidated companies, once they're in your controlled group, you cannot liquidate and terminate just that plan. You're stuck with it. And so if you want that flexibility, it's important to have that done pre-closing. There's other ways to address it, merging the plans, freezing the plans. There's various ways to do, but I think most of the time, the simplest and easiest thing to do is to terminate it. That's got to be on people's radar when they're doing transactions. And then finally, then we could talk for just a couple minutes on how onboarding and integration
Hey,
work.
Josh,
Yep.
I was going to say, well, before you move off that point, with the good one about terminating the 401k plan, people forget there's a nuance there as well. The 401k plan has to be terminated no later than the day before closing. So if you terminate it as of the day of closing, you don't have a proper termination. So I see that get messed up all the time. It's got to make sure you do it the day before the closing. People are going to say, well, what does that matter? Well, it matters a big deal because it may be the difference between allowing you to terminate, liquidate seller's plan, or it being stuck maintaining it as a frozen plan for a long time.
That's for sure. And I guess on that same nuance, it's not that people get worried. It's not that the entire plan needs to be liquidated and wound down by closing. It's that the effective date of the termination, so the board action to terminate it, has to be the day before. The actual wind down process almost always takes place for months and months afterwards, but it's just making sure that that board resolution is done and effective and set at the time period you mentioned it.
And that no deferrals are taken after that day before on a top. So you got to make sure you cut off your payroll system because you don't want to actually taking deferrals after the fact.
Exactly. And I just think the only last thing I think we could, as a parting thought, is just that it's important to think about where you've got this operating company buying another operating company. You've got to think through, and oftentimes, as early as you can, talk with the legal and HR teams of the buyer to make sure that they're working together to think about how the onboarding process is going to work. Do they have enough time to get people onto comp and benefit plans? How they're thinking through all that to make sure there's no hiccups and issues, particularly if your deal's close to year end, where it could be, not derail the deal, but cause a lot more problems than you could avoid. If you're the lawyer, you can help out with that. That's another area of value add.
Yeah, and keep in mind too, let's maybe pull all the way back to where we started, which is this is why it's important to review and understand the transaction agreement itself, because everything we just talked about should be addressed in writing in the transaction agreement, through either the reps and warranties between the parties, covenants to actually allocate who's going to be responsible for what plan or what obligation, to confirm what's happened in all of these outstanding equity awards at closing, whether they're being terminated or assumed and converted into a buyer award post-closing, any adjustments to purchase price that are mandated because of what you might have discovered in this process, adding closing covenants as to what will happen to plans or employees, or as you mentioned, the shareholder cleanse vote needs to be in the covenant agreement that has to be done by closing, for example. And so all this stuff, it has to be investigated, analyzed, and ultimately then addressed in the written agreement. So there's no, misunderstanding about what's happening and who's taking what liability. Because if it's not, and you end up having a controversy after the closing, the client's going to look to you as the lawyer and say, why wasn't this addressed?
Yep. I think that's completely on point and probably a great place for us to stop for now. Another insightful episode of our special edition podcast series. We hope you all found our discussion on executive compensations and mergers and acquisitions enlightening.
And if you have any questions or need further clarification on any of these topics we talked about today, Josh and I both are readily available to talk. Don't hesitate to reach out to either of us. We enjoy taking calls and glad to walk through any issue that maybe we ended up was being confusing or ambiguous or something. And thank you for listening.
Thank you.
Copyright Troutman Pepper Hamilton Sanders, LLP. These recorded materials are designed for educational purposes only. This podcast is not legal advice and does not create an attorney-client relationship. The views and opinions expressed in this podcast are solely those of the individual participants. Troutman Pepper does not make any representations or warranties, express or implied, regarding the contents of this podcast. Information on previous case results does not guarantee a similar future result. Users of this podcast may save and use the podcast only for personal or other non-commercial educational purposes. No other use, including, without limitation, reproduction, retransmission, or editing of this podcast may be made without the prior written permission of Troutman Pepper. If you have any questions, please contact us at troutman.com.